Hello, everyone. Thank you so much for joining into another episode of your favorite program, The Money Minutes. And as you have been listening to us the past few weeks, we are covering all the ideas and all these strategies of taking money out of incorporated business and making that into an efficient tax-free income for the owner. Hoping to do that. Aman, what do you say?
We've talked about, Seema, we've talked about the story about the income or the retained earnings building in the corporation. We talked about how to run a corporate insurance policy through the corporation. We talked about ways of getting money out through a health spending account. And I was thinking we've probably done. And you have another idea today. So what is it how can we take out more money out of the corporation tax effectively? What is it that you want to share today?
Yes. And that's the pain point, Aman, for incorporated businesses that are doing well. One of the biggest pain point is how do I take my money out of the corporation in a more tax efficient manner? We don't mind paying taxes, but at the same time, if there are ways of making it more efficient, why not? And like you mentioned, we've talked about health spending account, corporate owned strategies for life insurance, for individual pension plans. We've talked about also employee benefits that you can offer to your employees. Today, we're going to talk about a unique proposition. Basically it's a critical illness policy.
Okay.
It covers all critical illness that you can imagine. But more importantly, the idea is to split the premium between two owners. So the ownership is corporation, Aman, and the other ownership is the incorporated individual.
Okay. So if I were to understand that correctly, if I'm a professional and I have a professional corp and I am the professional, the ownership of the policy is with the professional corp and I am the insured?
Yes, you are the insured, but you also have to put up part of the premium. So there are two portions to this policy. One portion that says, I will give you a benefit if a critical illness happens.
Okay.
The other says, I will give you all your premiums paid if nothing happens. So a lot of my clients that are doctors, they're very health conscious as well. They're going for running in the morning, getting their workout an hour a day. So, and people are living longer. So this strategy works the best when it comes to if something happened, I'm covered. If nothing happened, which is more likely, I will have all the money that my corporation has paid and I have paid into the plan.
So, Seema, I think conceptually intuitively it makes sense. It's basically you're paying premiums to protect your health, and then you're paying an additional component to get a return of premium back, and how they're split is between the professional and the professional corp. But is there a table that you can share that basically illustrates this whole clearly?
You know what? Good question. Absolutely. Here we go.
Okay. So what do we have here?
So this is a male, 50 years old. He has a professional corporation. And as you can see from the table, let me just move this to the side. 22,000 is the annual basic premium for the coverage of $500,000.
Okay.
The other $4,000 a year is coming from the individual from his personally earned income to pay for return of premium. Okay. We also have return of premium on death. So if a death happens, your premium still comes back. So all three situations, if I die too quick, if I get sick, or if I live too long, what happens? All three areas are covered here. So total policy premium that is being given to the company is $27,000 a year. But here's the interesting piece. So the client from personal pocket has paid about $60,000 in 15 years. Yeah. And the corporation has paid the balance. The total premium paid is $413,000. Now, if my client wishes to take the advantage of return of premium, then at the end of 15 years, they could withdraw all 413,000 to themselves.
I
I mean, what could be better than you putting out 60,000 out of your pocket to receive 413,000 back from your corporation, and which includes the 60,000 you paid as well.
Right. So I think this just looks too good to be true. So and I just want to make sure I'm understanding the way it's being presented. So the 4,000 is what paid from the personal pocket over 15 years is 60,000. Overall, the premium paid was 27,000 into 15, which is 413,000. But you get that 413,000 back at the end of 15 years.
Absolutely.
Okay, so that looks like a very good use of corporate trapped retained earnings. So who do you think this would be a good fit for?
Very good question. So first of all, healthy people only.
Okay.
Critical illness is very tough to qualify for. So I would say anyone who is already on medication or have had a surgery, they are not preferred prospects. The other is someone who has retained earnings. So remember, our whole series of professional corp and business owner, we've been talking about the trapped cash in the corporation. If someone has no cash in the corporation, this is not a good product for them.
So good health and retained earnings that you're looking to get out tax effectively.
Good health, young age, have retained earnings. So the problem we're solving is cash trapped in corporation. Right?
Thank you. This has been very clear, very illustrative. And I'm sure we'll look forward to a next educative session.
And I want to use a disclaimer here, Aman, with your thanks here, of course, to everyone, is that any ideas or strategies that we're presenting to you, if CRA tomorrow decides to change rules, we can't help you. But so far, these things are very good and very good to make use of.
That's valid. I think it's hard to foretell the future, what stands, but I think in the relevant context, it sounds very decent strategy in terms of what we're trying to achieve here.
Absolutely. And we'll think of some more ideas and come back to our audience. Thank you so much. And don't forget to subscribe and like our channel. Thank you.